My name is Jake, welcome to the channel, and today's video we're going to do another Review My Pie video where I review subscriber portfolios. I still think it's incredible. Over the last 2 years, ever since I transferred my portfolio from Robinhood into M1 Finance, it's been such a great journey, great experience reviewing the progress with my wife while we're looking to reach financial independence through dividend investing, right? For those of you that are maybe new to the channel, my wife and I, we're in our mid-30s, we're looking to retire in the next 5 years, and we track our progress every single week. And with the pandemic, it's really, enlightened us in terms of, what is possible with our portfolio, what are really our priorities, where are we happiest, when are we happiest, and what we want to accomplish here in the next couple of years. We invest into real estate, we invest for cash flow. We're really trying to grow our portfolio so that it pays for our living expenses, so that we don't have to rely on our 9-to-5 jobs. And that's what it really comes down to. If you look at this chart here, the value over time, it's really been a slow process. My wife and I, we dollar cost average into our portfolio, and you can see that there's not a lot of fluctuation in price. Yes, it's going up and to the right. Sometimes you see a small dip, but then it continues to go up. This is really a slow path to wealth. You're not going to get rich overnight investing into the strategy that I talk about here on YouTube. There's a lot of other ways that you can get rich overnight, and that's not really what I talk about on my channel. I think it's so exciting to see how some people hit it big, but you never really hear about those people that invested at the high and sold at the bottom. And so investing into a company like this can be really exciting. It would never be my pure focus of reaching financial independence, but I still think it's really exciting to kind of view this from the sidelines. I was having a conversation with my wife a couple of days ago, and she asked me, well, why did you decide to invest in a dividend strategy? And I told her, I was thinking back, well, I was just never good at buying stocks at the right time and selling them at the right time. Whether it be index funds or individual stocks, it caused a lot of anxiety and stress, always thinking, okay, I have to get in at the right time and I have to get out at the right time. And with dividend investing, I just have to pick the right investment and it pays me. And it just clicked with me. It made such complete sense that, you know what, I can do this and I can focus more on what I can control. And what I can control is the amount that I'm investing week over week, the type of businesses that I'm investing in, and that's really it. That's the bulk of it. And that really resonated with me versus trying to pick the right time to buy in and the right time to sell. In fact, that's exactly what I talk about here on the channel with the 3 series that I have. I talk about dividend growth investing, I talk about financial independence and retiring early with dividend investing, and I also have the Review My Pie where we review subscriber portfolios. I really love this series of the Review My Pie because I love seeing and interacting with all of you and seeing how different people all across the globe are investing in this type of strategy. In today's Review My Pie, we're going to look at 4 portfolios. The first is from a 21-year-old here in the United States. The second, a 37-year-old here in the United States. The third, a 22-year-old from Denmark. The fourth portfolio is going to be from a 15-year-old here in the United States. As always, everybody, the timestamps are in the description below, and the portfolio links are in the description below. I don't pre-review or pre-script what I'm going to say in these videos. I'm looking at the portfolios for the very first time. And as always, everybody, I'm not a financial advisor. I'm just some random dude on the internet. Don't take what I'm saying as financial advice. It's just merely for your entertainment. I still think it is amazing that there's a 15-year-old out there investing in the stock market and is doing research and learning about finance here on YouTube. I think to myself, what the hell was I doing back when I was 15 years old? It probably looked a little bit like this.
Okay, it's recording.
Headshot.
Oh my gosh. Okay, all right. So the very first portfolio is from Dan. Dan writes, "Hi Jake, huge fan of your channel. I've been watching since your video, Best ETFs for Dividend Growth Investors. Just a heads up, you actually have a type on the..." Yeah, I fixed that a little while ago. Oh man. So you've been around for a while. If you've been watching since that video, you've been around for almost 2 years. So really cool. You spelled dividend, blah, blah, blah. All right, so I wanted to send over my M1 pie for you to review. This pie is my dividend growth income pie. I'm currently investing a minimum of $500 a month. That's really good, by the way, into this pie. I try to keep a current yield above 4%. I like to be able to use the dividends from my portfolio in the next 10 to 15 years for some, if not all of my expenses, and then into my retirement. I'm currently 21 years old, single, and live in Colorado. I also invest in a Roth IRA in M1 and in a 401k with my job. I've also included my Roth if you'd have time to take a quick look at that one as well. The Roth and 401k I plan on not using until retirement age. In the Roth, I'm prioritizing growth stocks and plan on starting to invest $500 a month or $6K a year in the new year. I net about $2K a month from my job and have about $950 in monthly expenses, soon to be lower due to a refinance on our home. With the decreased expenses, I plan on increasing my contributions to the Roth. I have no other debt. Wait, did you say you're going to refinance your home? So you're 21 and you have a home? Maybe you're doing something with your parents or something, but if you're 21 and have a home, like, man, that's really, really, in my opinion, I mean, everybody has an opinion on that, but I think that is great. My wife and I are able to retire much earlier because we invested into real estate. So I think, I think that's really great. Thank you very much for your time and dedication to helping others learn to invest. God bless you and your family and have a wonderful holiday. So you sent this in a couple of months ago. So Dan, thank you so much, man. I really appreciate the kind words. I think it is so great that you're breaking it down by month. You are tracking your expenses. You're looking to see how much you have. You're investing into your regular portfolio, a taxable portfolio. A Roth IRA is a tax sheltered account. So essentially you're paying the taxes now, but in the future, when you reach the age of 59 and a half, you will pay no taxes on the distributions. That being, if you have a capital appreciation or dividends, you'll pay zero taxes. So really great. So let's take a look at your dividend portfolio. You're up 40% over the last couple of years. This is a hypothetical chart. If you would have invested 5 years ago, you have just under a 4% dividend yield. The 40% is not considering the reinvestment of dividends. You have a pretty decent expense ratio that's a little bit higher than I personally would like. But I think, as long as it's under 0.35, that's kind of my threshold, the line in the sand for me. You got 59 holdings. This is quite a bit of holdings. You're 21 years old. I would, if I were to bet, you probably are going to be changing up your portfolio over these next couple of years. 59 holdings at 21. You're probably going to be changing that. So I think that's the very first thing that I'm noticing. You probably want to take a look and see if this is really something that you're going to be able to manage long term. So let's take a look at your slices. You got 62 in dividend ETFs, 21 in REITs. Your satellite holdings. So this is interesting. So you're following the core and satellite. I've been talking a lot about that on the channel. Really, really cool. I'm glad that you have implemented that. And you got bonds at 1%. So let's take a look at your ETFs. You got VIG, SCHD, Noble, SPHD, KBYD, and the International VIG. Okay, so I really like the Schwab SCHD. That's one of my largest holdings. If you're looking to access the dividend from your portfolio and you never want to sell your shares, this is once again the dividend portfolio, I would encourage you to maybe reconsider some of your holdings. I went through a very similar process when I was first setting up my portfolio. I didn't fully understand my timeline. And then once I really figured out, okay, the timeline is 5 years, 10 years, whatever. I mean, nobody has a crystal ball, but with Noble and with VIG, for example, these are great ETFs, but it's going to be very difficult to live off of the dividend income in the next 10 years. Noble and VIG is more of like a 20 plus time horizon. And I think if you wanted 10 to 15 years, I think your focus should be on ETFs like SCHD, maybe SPHD. You could look at, you have REITs in here as well. You could look at SPYD. That one has a really good dividend. Something like that, or VYM from Vanguard. Those kind of ETFs are going to serve you better if your goal is to not sell your shares. That's the key thing. But in terms of like the quality of the ETFs, these are all great high quality ETFs. Like there's nothing wrong with them. It's just an ETF like SCHD is going to help you reach your goal faster than VIG. Let's take a look at your REITs at 21%. You got your satellite REITs. We'll take a look at that slice here in a second. You got the Invesco Premium Yield ETF. What's the expense ratio on here? Expense ratio? Okay, that's fine. Has a high dividend. Yeah, I think this is fine. It's not my favorite, but it's also not the worst out there. I think it's a fine ETF. Your REITs here, you got AMT, you got GLPI, you got NRZ and O. I really like O. I really like AMT. The gaming one and leisure. So GLPI, I think it's okay. I'm glad that you don't have it more than 10%. NRZ is okay. It's not personally my favorite. In my opinion, if you want to focus on REITs, I made a lot of great videos. The last 3 videos that I made, not including the Review My Pie, were on REITs. I'd recommend going and checking out my last 3 videos. I talk about some really, really good REITs in there that I think would fit very, very well in a portfolio with a 10 to 15 year time horizon. All right, let's take a look at your satellite holdings. Okay, this is where the bulk of your holdings are. So you got your satellite holdings, 42 holdings in 16%. This may be a little bit overkill. Now, you could always adjust this as you get closer to retirement, but let's take a look. So you got a very high dividend yield. You have a pretty high expense ratio. We talked a little bit about that. Let's take a look at your ETFs. You got QYLD. Okay, all right. So yeah, I mean, with QYLD, I've talked about that on the channel. I think it's an okay ETF. With your time horizon, investing into M1 Finance, where it's reinvesting the dividends into your other holdings, I think it can make sense. The ARK ETF, yeah, I mean, you're going to be selling out of this in the future. So yeah, I think it's okay. It's a little bit of a different strategy. I personally always like to have growth separate from my dividend portfolio, just in a different brokerage or different portfolio altogether, or in a completely different slice in M1 Finance, for example. It just helps me to, kind of mentally position them. Okay, this is my dividend stock. This is my growth stock. It's just personal preference. All right, so your consumer staples, this is actually really good. Your consumer staples, you're focused on, you got Disney. That's okay. So I guess you're just kind of bucketing all of your consumers in here, discretionary and non-discretionary. You got your Walmarts, you got your Amazons of the world, Starbucks. These are all established companies. I mean, Kraft, yeah, okay. It has a high dividend yield, not the best track record, but has a good dividend yield. I really am a big fan of Kellogg's. Colgate, I don't think anybody can go wrong with Colgate or Clorox. Boeing, yeah, I think Boeing is fine. McDonald's, Home Depot is great. Huge dividend growth company in Home Depot. Coca-Cola, Hershey's. Yeah, I think these are all great companies. I mean, what it really comes down to is, so you know how I mentioned with all of your holdings, you're going to have maybe a difficult time following up on these companies? Look at these companies, right? You're not going to have to follow up on Disney, Walmart, Starbucks, Hershey's, Target. These are all established companies. I do believe that in the future, you may be slimming, cutting some of these holdings from your portfolio. Maybe your priorities change, but as it stands, these are all really, really great companies. I don't think anybody could go wrong with those type of companies in their portfolio. Let's see, you really have a lot of layers in here. Okay, so you got your broad satellite positions, you got your tech, you got your big tech in here, you got your communications. Okay. I'm a bigger fan of Comcast. I really, where's Comcast? Where's Verizon? I think would be better fits personally. Financials, JP Morgan, Goldman Sachs of the world, Visas, Aflac. Yeah, I think those are fine. Energy, VDE, okay, good. If you're going to go the energy route, I don't think going with the Vanguard sector ETF. I think this is a good approach. I personally would probably do that myself if I absolutely wanted to have energy in there. Utilities, VPU, also really great. There's a lot of good utilities. Check out your utilities. I mean, if you wanted that 4% dividend yield, you should take a look at, or I would definitely consider taking a look at Duke Energy and Southern Company. Those are really, really good Really, really good ones. If you even look into here, I'm pretty sure it'll show. Yeah. So you got Duke, some of the largest holdings in VPU. You're already going to get exposure to Duke and Southern Company, but you're going to get a higher dividend yield by holding the companies themselves. Materials, VAW, okay, the sector materials ETF from Vanguard. And industrials, yeah, these are all great. Like I said, you're like 88%, 6%, 3%. It's very likely that you're going to change these percentages quite a bit over time. But I'm sure it's fun. I'm sure it's a hobby of yours. Let's take a look. Your last slice with the bonds. Okay, so this is my opinion. I think this is a bit overkill. I don't think you need to have all of these bonds. In my opinion, don't overcomplicate your life, right? Like don't clutter your life. That's my opinion. You know, don't have 10 different types of the same thing. I mean, some people like that. People like having different colors of the same shoes, right? But in my personal opinion, stick with quality, right? Go with one that you really understand. BND is my preferred bond. If you're going to hold bonds, I really am a big fan of BND. I don't think, in my opinion, need all of these bonds in your portfolio. Yes, they're all different, right? Every single one of these are different. But I think if you really wanted to get exposure to the total bond market, BND and BNDX, and you covered all of your bases. That's my opinion. And having bonds at 1%, I think it's fine. You could adjust it over time. You know, you could have a couple different reasons why you hold that. For example, if you wanted to sell bonds when the market corrects and then reposition from your bonds into your other holdings, or maybe it's just an emotional, benefit of holding bonds in your portfolio. It stabilizes the portfolio. All right, now let's take a look at your other portfolio, your Roth IRA. Your performance is much higher. You did mention that it's focused more on growth. I do like that you have all ETFs with also the Berkshire is like an ETF. It's like an ETF. I like that you have it all really just ETFs in here, because the Roth IRA, you're going to be you're going to have this account for the next, 40 years, 35, 40 years until you start tapping into this portfolio. And so VIG is fine. The small cap here is fine. Yeah, I mean, this is fine. One that you don't have in here that I think would definitely be interesting to take a look at is VGT. It's the technology one. It's a little bit different than the Vanguard Growth, VUG. VUG is focused on the S&P 500 growth, so it has different sectors in this. The VGT is just on information technology. It's one of the highest performing ETFs out there with a very low expense ratio. So I think this is fine. The one concern that I have is year over year, you might be thinking, oh, am I over do I need to put 17% in this and 13% in this? Like, there's so many things that could come up. When it comes to this, you want to set up your Roth IRA in a way where you don't have to make any changes, no more than once a year, right? You could review it once a year, but in reality, it's just you set it up once, you dollar cost average into it every month, and you evaluate it maybe on a yearly basis, and you set it and forget it. But yeah, I think, in my opinion, the way that I have my Roth IRA set up, I have the majority in VGT. I have a good amount into the total stock market in VTI. That's the total US stock market. I also have VXUS, that's the international ETF, and I have a little bit in VNQ. This is the real estate Vanguard ETF. And that's really all I have. I set it up and I forget it. Well, Dan, thank you so much for sending over your portfolio. I hope that this was helpful. I think, if I were to summarize some of my comments, try to declutter your life. Like, just in general, that's always a good idea. Focus on, what is really your goal? And if what you're doing, is that going to make your life easier or more of a burden? And based on the answer of that question, I think you know what to do. Thank you again so much for sending over your portfolio. The next portfolio here is from Dave. Dave writes, "Hi Jake, my name is Dave and I've been watching your channel since the start of 2020 when I discovered it. I absolutely love the Review My Pie series that you do. This is what got me started with M1 Finance and I'm very happy it did. Keep up the great work, please." Dave, thank you so much, man. Like, reading this kind of stuff is exactly why I started the YouTube channel in the first place. And it's why I continue to do it. This is so great. Thank you. All right, background, I'm 37 years old and live in the Dallas, Texas area. I have an account with Charles Schwab that has my 401k and some individual stocks in addition to M1 Finance. I'd like to retire around the age of 55 and live off a goal of 50K per year from my dividends, so that gives me around 18 more years. I've been adding 200 per week into my M1 account and will be inheriting around 500,000 in about 6 months from now. I think I'm going to put 300K into this M1 account, so I'm curious to hear your thoughts on how it should be set up and allocated. I'm also open to any advice on adding or deleting any companies. Thank you, Dave. Well, Dave, thank you so much for the kind words. I think this is really interesting. So a few points that I would make. So you're looking to retire or at least live off the dividend income in the next 18 years. 50K in 18 years is not going to be a lot. You see inflation is hovering anywhere from 2, maybe 3, 4%, who knows? The Fed has a target inflation of about 2.5%. So that 50K is going to get eroded over the next 18 years. So that's the very first thing that I would do is I would look at, okay, do you need 50K to in today's dollars in terms of purchasing power? If that's the case, you need to go check out an inflation calculator and see what you would need, the buying power of 50K in 18 years and what dollar amount you would need. So very, very, very important. And the fact that you're inheriting, such a large amount of money, I would encourage you to even potentially seek professional financial advice. It's something that where you're getting such a large sum of money, this is life altering, this is life changing, and you don't want to take that, you don't want to risk anything. At least that's my opinion. I'm very risk averse. And if you were to be in that situation, I think you don't want to it's like if you win the lottery, right? You don't want to just go and just make a rash decision. You want to make a very calculated decision, and it shouldn't be something that you rush. That's just my personal opinion. All right, Dave, so let's take a look at your portfolio. Over the last 5 years, you're up 54%. This is actually not accurate. M1 Finance does not track the historical performance of companies that did not exist. For example, beyond 2020, you must have some IPO'd companies in this account because M1 Finance is not showing the historical performance over the last 5 years. So this number right here, is actually just from the last year. So you can kind of disregard this 5-year thing. It's a little bit funky, but it's important to understand if there's an IPO'd company in your portfolio, you're not going to see the full 5 years. You have a decent expense ratio. You have a decent dividend yield. It's hard to compare the dividend yield with the historical performance simply because it's only been a year. You have 57 holdings. You've broken up into ETFs, dividend stocks, and growth. I like that you have this broken up. I really like it, with growth separate, dividend stock separate, and ETF separate. I like this. Let's take a look at your first one here. You're up 313%. Holy cow. Okay, yeah, so you're definitely destroying the S&P 500. You have 5 holdings. You have a decent dividend yield, a decent expense ratio. It depends on what you have in here. Okay, you got ARC, VTI, VYM, SEHD, and ARC Genomic. Holy cow, this is actually really interesting. Dave, I actually really like this. I really like this. When you focus on the total returns of your portfolio, you're focusing on the hyper growth of the ARC ETFs while also focusing on these really, really high quality ETFs. Now, if it was me personally, it really depends on your strategy because you're not going to live off the dividend from the ARC ETFs. This is purely for capital appreciation. If it was me, it really depends on your goal, when you want to sell them, etc. But as it stands, I like the ARC ETFs. I really am a huge fan of the total stock market. VYM is one of my largest holdings in my portfolio. SEHD is one of my largest holdings. This is actually a really, really cool slice. And I could actually see myself doing something similar, but I would lower the exposure to the ARC funds. But I really, really like this. I think it's a really cool way to approach investing. It's kind of a hybrid of dividend, value and growth. I kind of like it. Your dividend stocks, you got 36 in here. They're all fairly equally weighted. You got one of my favorite dividend stocks up here in Waste Management. You got Walmart, Visa, Starbucks, Southern Company, UPS, Target. these are really, really great companies. You have a little bit of real estate exposure, so not too bad at all. You got Procter and Gamble. All these companies, I'm sure the majority of people watching this video are familiar with, right? You got Kimberly-Clark, JP Morgan, Johnson & Johnson, Duke. These are all such really, really great companies. A lot of these are dividend aristocrats. Some of them are even dividend kings, right? You got Stryker in here. Not a lot of people have Stryker. That's great. Lockheed Martin, Apple. Every single one of these companies, this is a great portfolio. Like, honestly, like, I think this is a really, really high quality slice. Yes, there's 36 holdings, right? And what I mentioned in the first slice or the first portfolio review, it's kind of something similar, but I actually like this a little bit better because of the way that it's structured in the portfolio. It's pretty straightforward. I like it. You have very limited exposure to real estate, by the way. So you're very focused on qualified dividends. So if this is in a taxable account, you're getting the best tax treatment because they're mostly qualified dividends. All right, let's take a look at your growth. Your growth, you got your Teslas, Squares of the world. So you're going to get a little bit of double exposure with the ARK ETFs. But if you have full conviction in these companies, I think that's great. This slice, you probably see, I was thinking exactly this. You probably have been on a little bit of a roller coaster this year, right? It hit all-time highs here in February. It's been down, but it's also been correcting quite a bit. So yeah, I mean, you got the Neos, the Lemonades of the world, the Pelotons, the Zillows, Redfins. I think these are great growth companies. The one thing that I'm noticing, you don't have a lot of like the mega caps. I mean, you do have Amazon, you do got Google, but you don't have like the Microsofts. You had Apple before, but it's mostly focused on small and mid cap growth stocks. So you're going to see a lot more volatility in here, but these are all great. I mean, Shopify, come on, like this is Canada in one company for the most part. I love Shopify. I'm a big fan of Square, right? Like this is a great portfolio. Okay, so Dave, I really like your portfolio. I think it's too bad you can't see the historical performance. It's because of the IPO companies in your growth slice. But as it stands, I like the portfolio. I like it. It's a little bit more of an active approach. It gives you flexibility. You have the growth in there. Maybe in 10 years you wanted to buy a house. Well, what do? Well, you sell your growth stocks. Or let's say in 18 years you wanted to fully just live off the cash flow. Well, what do? You reposition out of the growth stocks into the dividend stocks. It's pretty straightforward. There's things that you have to be aware of in terms of the tax implications that come with that. Making sure that you're doing it at the right time. No one has a crystal ball what the tax rates will be, but investing for tax efficiency is going to be big there. But as a whole, man, I like it. I think it's pretty cool. It's interesting. Yeah, thank you, Dave, for sending over your portfolio. Oh, let's take a look at the next portfolio from Tom. Tom writes, "Hey Jake, sorry for the bad English. I'm dyslexic and English is not my first language." No worries at all, man. My name is Tom. I'm 22 years old from the little country called Denmark. Bernie Sanders loves us. All right. I really enjoy your channel and the Review My Pie. I really enjoy. That is great. Thank you so much, Tom. So you're 22 years old and you'd like to retire by the time you're 35, but no later than 40. You invest about a little over $2,400 US per month. And at the moment, no less than 2,000 per month. That's really good. You do not have any ETFs because you're investing for the long term and you're trying to beat it, and you're also not worried about the high risk. I can understand that. It makes sense. So, I mean, ETFs are not for everybody. So just a quick info, you're investing for the next couple of years. You're looking to get into Pepsi, Altria Group, Realty Income. So your value is at 25K at the moment. You have a high starting yield, just under 8%. And you started in January 2020 and you made 4K in profit. All right, so let's take a look at your portfolio. Over to the left, you have the individual companies. Over to the right, you have the portfolio weighting. So I like that you have the portfolio weighting in there as well. So you also break down your average cost, the dividends per share. You even have it when it's paid. Man, Tom, this is really, really smart. When you look at the month in which it's paid, if it's paid every month on the pay cycle, that is really, really important. So if you're already thinking about this, you understand the importance of cash flow. So if like, say for example, you rent or you have a mortgage, you have to pay your bills on a monthly basis. So unless you're able to budget very well, if it only pays quarterly, having stocks that pay on a different pay schedule can be a really good idea. So let's take a look at it. You have the sectors in here as well with real estate, energy, consumer staples. Let's see here. So you got realty income here at 9%. That's a very high weighting. It's a great REIT. You got AG&C. This is a mortgage REIT at a little bit of a lower rate. You got CRT. You got ORC. This is another good REIT. Stag is another REIT, which is also really good. You got Altria Group, Iron Mountain. Interesting. So let's see, which one is the 10? You got Altria Group at 10%, Stag at 10%. So you got some really good REITs in here. I really like Stag. I really like Realty Income. Iron Mountain is an interesting one. I'm really curious to see what Iron Mountain does over time as they evolve their business, right? So they're entering into more of a data center model, I guess you could say, and not just focused on actual storage of paper, but actual of information. A random thing here, when my wife and I were in New Zealand in 2019, we saw an Iron Mountain facility, which was so random, but I mean, Iron Mountain is all over the globe. You got Coca-Cola, you got Apple, Energy Transfer. My dad, who is currently retired, always talks about Energy Transfer, always, telling me to take a look at it. ET. You got AT&T, AbbVie, Pepsi, 3M, Consolidated Edison, McDonald's, Kroger. Oh, you got the ARC one in here. Mac. I'm not as familiar with Mac. I'm not sure what that one is. Microsoft, Nextera Energy. And you got Disney down here. Okay, so great. So you're very heavy in real estate, which I think I'm not as familiar with the real estate taxes in terms of Denmark, so what the international tax would be. But that's one thing that I would definitely make sure that you're aware of what the tax implication would be as a citizen of Denmark investing into U.S. REITs. So very, very important, because it can be anywhere from 15 to 20 to 30% in some countries. But I think it's, if I'm not mistaken, I think it's around 15%. If you know the tax rate for Denmark, please leave it in a comment below. I'm not 100% sure. But as it stands, the companies that you have in here are really, really strong. Well, Tom, one thing that does stand out is you're a little bit focused in only a handful of sectors. You're really focused on real estate. You're focused on, you have some energy stocks in here. You have some consumer staples. I would definitely take a look and see at what your exposure is to each individual sector. There's 11 sectors in the stock market. My rule of thumb is to not have one individual stock make up more than 5% of my overall portfolio. And I try not to have more than 20% exposure of my overall portfolio into one single sector. Tom, thank you so much for sending over your portfolio. All right, the last portfolio is from Ryan. Ryan writes, "Hello, Jake. My name is Ryan, and I'm currently 15 years old. I started investing about 2 weeks before the pandemic started and lockdowns went into effect. I currently have about $6,000 in my custodial account, including cash. My goal for this portfolio is to reinvest dividends for the next 10 to 20 years and eventually have a cash-generating machine. I plan to get a job at Starbucks in November when I turn 16 and invest about every paycheck I get. I enjoy doing research on companies on my own. My current source of income is doing seasonal jobs and holiday birthday money. Thank you for creating these videos for me and other dividend investors. Here's a spreadsheet of my portfolio. I plan to start making YouTube videos soon under the name Ryan Dangler Show. Thanks." Well, Ryan, thank you so much, man. Like 15 years old, you've created a financial, personal finance YouTube channel. You're doing all the research yourself. Like, you have a custodial account. That means you have really great parents. Your parents have educated you and informed you on the importance of investing and financial education, financial literacy. All right, Ryan, let's take a look at your portfolio. You got the tickers over to the left and you have the sectors over to the right. It doesn't really show what your weighting is. That's something really important. You want to understand how diversified your portfolio is. You want to make sure you're understanding, okay, what is the percentage that you have in each individual sector. So that's something to definitely take a look at. Let's see. So you got AT&T in here, you got Apple, Microsoft, Starbucks. Starbucks is a great growth company. If you're 15 years old, companies like Starbucks, McDonald's, those are the kind of companies that definitely should be on your radar. You also got AbbVie, Target, you got Realty Income, you got Clorox, 3M, UPS, you got Hershey's, Coca-Cola, Nike, Waste Management, Chevron, Colgate, NextEra Energy, Berkshire, Disney, Kroger, and a few others in there. So this is great. You don't have a lot of exposure to real estate. That is fine. So here's the thing. When you're investing at this young age, you're not going to necessarily know what your goal is, and your goal is going to change. And so I'm always a big fan of setting up your portfolio in a way where it creates flexibility for you in the future. There's so many things that could happen in your life over the next 10, 20, 30 years. It's insane. Like there's so many things that could happen. So investing into a company like AT&T at this young of an age is not, in my opinion, not the best thing to do. You could invest into AT&T right now. You could invest a lump sum, and then you could use the dividend to invest into other companies. But if you plan on reinvesting the dividend of AT&T back into AT&T for the next 20 years, I personally believe that that's a missed opportunity. I don't believe that that's the best choice given your timeline or your time horizon. Now with Apple, I think reinvesting the dividend back into Apple or Microsoft or Starbucks is a phenomenal idea. I think that is a great idea. Johnson & Johnson is kind of something similar like AT&T. Johnson & Johnson is a great company, but at your age and with your timeline, I think limiting the exposure to Johnson & Johnson is important. Johnson & Johnson's great to stabilize your portfolio in times of market volatility, but it's not something that, in my opinion, you want to focus on heavily right now. AbbVie is a little bit of a unicorn where it has such great growth potential and it has a high starting yield. If you wanted to reinvest the dividend, I think that would be fine. So this is kind of the trend that I'm getting on with the remainder of the portfolio. The question is, do you reinvest the dividend into these companies, or do you leverage the dividend to buy shares of other companies? So for example, AT&T, if you're going to reinvest the dividend, I think that's not the wisest idea. That's my opinion. The same thing with Chevron. However, with Waste Management or Nike or Hershey's or UPS, these are great companies to reinvest the dividend. So that's really the key thing that you need to ask yourself. How are you going to leverage the dividend? And what is your goal? Are you planning on never selling the shares? Are you planning on buying the shares now with the hopes of selling them later? In my opinion, I would do both. So like I mentioned, you don't know what's going to happen in the next 10, 20, 30 years. So why not set up the portfolio in a way that you have options, right? So for example, you have some holdings where you're like, you know what? I'm never going to sell Starbucks. I'm never going to sell McDonald's. Then you dollar cost average in those and you reinvest the dividends, and those are your core holdings. And then you have other holdings in there that are maybe, you know what, maybe they're your satellite positions where you're like, you know what, I'm not 100% sure if I'm going to hold on to these forever, but you know what, I would still like them in the portfolio to balance out the portfolio. Now this could be a Johnson & Johnson. This could be maybe a different type of company, but that's what I would focus on if, this early in your life, and you are off to an amazing start, right? You are miles ahead of the majority of people here on this earth, right? Like if you talk to your friends, like the majority of people at that age don't invest in the stock market. They're not interested in it. So the best thing that you can do, in my opinion, at this age is focus on a few things. Focus on increasing your financial literacy, exactly what you're doing, right? Educating yourself on investing. And I promise you, as you educate yourself, especially at a young age like this, your priorities and goals are going to change. And that's completely fine. It's like you probably have heard people that go to college, they start one degree, but they end up changing, halfway through. And that's completely fine. That is what we call life. So focusing on your financial literacy at such a young age is so important, and also getting those habits, establishing those good habits today of staying out of consumer debt, keeping your expenses low, and looking for new ways to make money. Exactly what you're doing, man. You're going to be one of the very few in this world that reach financial independence whatever that means for you personally, at a very, very young age. I think most people would agree with me that they wish they would have started at such a young age. Ryan, thank you so much for sending over your portfolio. Thank you so much, everybody, for watching. I hope you all have a great week, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.